Okay, today we're going to discuss some logistics, brokerage firms, account types, and thwack annuities, because they're a type of account. And we were looking for some stock market jokes. Now, I already told you the first stock market joke, right? How do you make a small fortune in the stock market? You start with a large fortune. So I went searching for some good stock jokes, and there really aren't that many. But this one I thought was pretty good. And I going to do my best Rodney Dangerfield impersonation, but oh, he was such a good comic. He had such a distinct delivery. I tell you, the stock market is bad. It's even worse than a divorce. You lose 50% of your net worth, but you keep your spouse. How'd I do, Rodney? We miss you. Anyway, have you ever wondered why they call us brokers? So, there are three major types of brokerage firms, although the differences between the three are becoming smaller and smaller. There's the full service brokerage firm, Merrill Lynch and Morgan Stupid. Merrill Lynch and Morgan Stanley that provide investment recommendations and the like, and take you to the steakhouse and the golf course and send you a bottle of wine on your birthday. And then there's the discount brokerages, which started in the mid-70s. Before that, they weren't any discount brokerages. They've consolidated quite a bit, and now the major discount brokerage firm is Schwab, which is a very good company in my humble opinion. They traditionally left the stock picking to the investor, but they now have their own stock rating and recommendation services. And then there still are, the deep discount brokers, the internet brokers that started with the advent of the internet technology. These are companies that have emphasized technology to reduce brokerage costs dramatically. What can you expect to pay for each? What kind of service can you expect from each? Well, obviously, the more you're going to pay, the more you're going to expect. Although, in my humble opinion, I don't really know if the full service brokerage firms are worth the money they charge you, because what I've seen, the way they treated people. Now, maybe I just haven't seen people with enough money. Yeah, I guess they're treated a whole lot better, aren't they? I don't really know. And again, so I can't really comment. Although I've seen some people with full service brokerage firms who have not been treated well. And I thought, wow, this is interesting. You're paying a lot of money for their services, and you're kind of getting screwed at the same time. What a bad deal that is. So, what were the commissions then? What were the commissions, and what are the commissions now? Well, traditionally, virtually all brokerage firms made their money from the commissions. And the full-service brokerage firms, you can expect to pay $70 to $100 or more per trade. The discount brokers started at around $45 in the 70s and 80s, and then went down to $29, and then $19, and then $13 and $9 per trade. And the deep discount brokers were $5, $8, $10, $7 per trade, or less now. The mutual fund companies got into the act. Now Fidelity and Vanguard have their own brokerage firms. People think they're still dealing with the mutual fund company, and in a way they are, but they're not the same company. And they allow you to have free commissions on their own funds, of course. Very smart marketing. But then, starting around, 15 years or so ago, a few companies experimented with $0 commissions. One failed, the other one started charging $5, they couldn't make it. But then came along Robinhood. And Robinhood has become very famous and now infamous with tech-savvy young adults. But as we've seen, folks, Robinhood is not free. No. How can a brokerage firm make any money with a $5 or even a $0 commission? Do you remember this slide from chapter 3? Introduction to stocks? The following disclaimer is placed on each trade confirmation from Scottrade, which, by the way, doesn't exist anymore. They were bought by TD Ameritrade, which had merged with TD Waterhouse and Ameritrade, and then TD Ameritrade was bought by Schwab. Consolidation. the urge to merge and get bigger and bigger and bigger. Scottrade Incorporated receives remuneration for directing orders to particular broker-dealers or market centers for execution. Such remuneration is considered compensation to the firm, and the source and amount of any compensation received by the firm in connection with your transaction will be disclosed upon request. It's called payment for order flow, or innocently enough, order flow. The market makers are kicking back part of the markup when you buy and mark down when you sell to the brokerage firms. So the brokerage firms, they got to make money some way, right? No one's going to work for free. How are they going to pay the rent? How are they going to pay their employees? So what's happening is that you're paying more than the going price. And if you'd gone with the full service or discount broker, which is what, has traditionally been the case. They give you the best price. Well, that's when you paid the commission, but not anymore. No, you're not paying a commission, so they're getting a kickback, and the market maker is charging more than what you would normally have paid per share, and you're getting less when you sell. But we've already gone through this, right? The margins now are so small that, yes, we're paying a whole lot less. The vast majority of us who are buying 10 or 20 shares, but people who are buying 100,000 shares, they're not happy about this. The pension funds, the mutual fund companies, that's why there's the controversy that we discussed way back in chapter 3 with that one exchange, IEX, that's creating the speed bump that has the high frequency traders very upset. Stay tuned for continuing developments, because now this is what, where are we anyway? Later 2021, and the SEC is floating the idea of possibly banning payment for order flow. I don't think it's going to happen. There's a whole lot of money behind these companies like Citadel and Virtu, who are behind Robinhood and the others. We'll see. We'll see what happens. Then there are alternative methods of paying your broker, because as the competition for your business has gotten fiercer, the methods of charging investors for investment services have gotten more creative, shall we say. There was a short period of time when Merrill Lynch experimented with charging their customers $3,000 a year for unlimited trades, but they don't have that program anymore. And there are other methods. The new modern day go-go way to soak your client. I'm sorry. Charge for brokerage services is called assets under management, wealth management. Slide number 6. This, dear students, is now being hawked by pretty much all the brokers now. And I feel like an anachronism, which is a fancy way of saying an old guy, which I am. The wealth management accounts, the wrap accounts, the investor advisor accounts, instead of charging commissions per transactions, the brokerage firm tax on a yearly 1 or 2% assets under management or wealth management fee. We're not your brokers. Oh, no. We're your wealth managers. Remember the mutual fund F shares or FI? These types of programs, as we said, are being pushed by all the major full service and discount brokerage firms. There are many flavors of this program. And the latest wrinkle, which is actually not that, this has been around for almost 20 years, not quite, is the new performance-based wealth management program. You only pay your advisor when you make money. The advisor receives 10 to 20% of your earnings when you make money, and the advisor receives nothing when you lose money or do not make anything. So it's a variation of the way hedge funds charge their shareholders. So this started mid-2000s or so when the market was going up. So I thought, I went to a seminar of one of these companies, Dunham and Associates, which is a local company here in San Diego. And I thought, next bear market, they're going to be in trouble. So what do? Every quarter, they set a high water mark, and then you don't get charged until the next quarter go over that high water mark. See what happens in a prolonged bear market? They don't make any money, and now obviously they can't pay the rent. But 10 to 20%, they're taking 10 to 20% of your earnings. Yeah. Although it sounds tempting, the reality is that you have the potential to pay far, far more for your investment services using this and the traditional, not the traditional, but the other way, just charging 1 or 2% a year. Pay the commissions and be done with it, especially if you're a prudent, long-term oriented investor who buys and holds their investments for the long term. But if you're a brokerage firm, oh boy, wouldn't you love to just stick your needle into people's arms and just start sucking out their 1 or 2% a year? Or every time they make money, taking 10 to 20% of that? And as I expected, or anticipated, during the prolonged bear market, 2008, 9, 10, 11, 12, Dunham altered their fee structure, so they now charge much, much less when the account does not gain, instead of just charging nothing. And by the way, that if you remember way back when we discussed mutual funds, the Alliance, AB now, I still call the company Alliance. AB, Alliance Bernstein AB, large cap growth fund, which is an excellent fund, by the way, fabulous fund. They do the same thing. If they don't perform, they lower their fees to that of an index fund. So in other words, they're saying, look, you want the best of both worlds. You want low fees, or do you want active management? You can get both. If we do well, we charge you. If we don't do well, we charge you what an index fund charges you. So there's a lot of competition for your investment dollars, dear students. But for me, I'm not a big fan of assets under management. In fact, I don't think it's in the best interest of the clients. I don't have any clients. I don't want any clients. I'll try my best to explain to them that they'll do better over the long term. We showed you the illustration back in when we discussed mutual funds of what happens when you have 1 or 2%, actually 1.25, right, which is what Fisher Investments charges. What happens over the long term when you have that? And this was about not quite 10 years ago. I was at one of these seminars where we were all wearing our best suits, and my suit was nowhere near as good as this guy's suit. And we're sitting at the table and discussing assets under management, and my contribution to the discussion is, I said, I just don't believe that these are in the best interest of our clients, because they're going to wind up spending far more, assuming they're prudent, long-term buy and hold investors. Obviously, if you're a buy and sell, then pay the 1%, 2%, because you're going to rack up tremendous commissions if you do. And this guy in a very expensive 3-piece suit with beautiful hair, I don't know how much he paid for his haircuts, but it's a lot more than I paid. And he just looked at me funny. He said, "What are you worried about? You send them a bottle of wine on their birthday, take them to the golf course, to steakhouse, they'll love you." And, usually I'm not at a loss for words. But I wasn't going to argue with the guy and say, but that's not what I said. I said it's not in the best interest of the clients. And obviously he thought, what are you worried about? What's the problem? The clients are going to be happy, so they pay. And so you have to make your decision, dear students. You have to decide. And by the way, they usually don't want you unless you have $50,000, $100,000. And now I hear talk of people saying, well, I don't take a client unless they have at least $500,000. And I'm thinking of moving that to $750,000. And that Fisher Investments guy, Ken Fisher, I keep haranguing on him. But in his advertisements, he says, if you have at least $500,000, you need to contact me, as if to say, I'm doing you a favor. But I do agree with Mr. Fisher. He hates annuities, and so do I, and we're going to discuss that in a bit. So there you go, folks. But what if you decide, I don't want a broker? You don't need a broker, especially if you are interested in large companies with their roots deep in the economy. You can do the dividend reinvestment plan route. You can use DRIPs, or sometimes called direct low cost investment plans. You go to the company's website and look for investor relations or investors or whatever, something along those lines. And there's usually an ability to have a dividend reinvestment plan directly with them. And we showed you one back in chapter 3. Yes, they are low cost. Some are, pennies, the one we had with Sempra Energy, SDG&E. But they're not perfect. How would you like to sift through 18 different statements? Now, some companies will charge a monthly fee to allow you to keep all your DRIPs in one place. Here's an example. Interactive Brokers, I think they charge $10 a month, which is, again, hardly anything. And many traditional brokerage firms now say, hey, you want a DRIP? No problem. We'll give you a DRIP. We have that, so if you want to, but you still pay a commission to buy the shares, but we'll allow you to have your dividends reinvested in the shares automatically with no charge. Cool. So now let's turn our attention to accounts, because there's quite a bit of confusion, and hopefully I'll do my best. We'll do our best to clear it up, but there's still going to be confusion because people tend to confuse the type of account with the investments that go in the account. So here's you notice I don't use too many graphics because I'm very graphically challenged. But these are supposed to look like buckets or bins or whatever, bolsas or whatever. And so on the left are taxable accounts, regular taxable accounts. You're going to hear all three. And these are the type of accounts that are the default. If you don't ask for something different, they're going to assume you want to create a taxable regular account. There's no limit on the contributions, there's no limit on the investment types, and you pay taxes every year. And in January, you'll get a 1099 of various types where you have to declare that on your taxes and pay taxes on any interest, dividends, capital gains. And these are the investments that can go in the account. Now, it's supposed to look like they're inside the bucket. I don't know if it does. But notice, stocks, bonds, cash, mutual funds, but also options, futures, shorting, buying on margin, and real estate. So you see that? No limit on contributions, no limit on investment types. You pay taxes every year. On the right is just one example of what the IRS calls tax qualified accounts. Now, there are various types of tax qualified accounts, educational savings accounts, health savings accounts, but we're going to just key on the retirement accounts because they're the most popular. And notice that the number of investments shrinks dramatically, doesn't it? The Congress says, no options. Well, there's actually one option transaction, the covered call. No futures, no shorting, no buying on margin. And by the way, we don't want you to put real estate in here, but there actually is a way to do that. Don't do it. It's very dangerous. Yeah, horror stories. So don't, but find a trusted advisor who knows what they're doing, and hopefully you won't get screwed. But assume that you're just going to go with the usual stocks, bonds, cash, and maybe short-term investments. Notice there are strict limits on contributions. There are strict limits on the investment types, and typically they are tax deferred. That's why the IRS calls them tax qualified. You don't pay taxes now. You don't get a 1099 at the end of the year. You pay taxes when you take the money out. In some instances, the Roth IRA, they are tax-free in retirement, and we'll discuss these in detail later. But although there are many subtle and not so subtle differences, the major differences is how they are taxed by the IRS, how much money you can contribute, and what you can have in your investment account. So you'll hear people say, well, how much money can I make in a Roth IRA? And it's the wrong question. How much money can my investments in the Roth IRA make? You see? The Roth IRA is just the bucket, or the 401k is just the bucket, or the regular account is just the bolsa, the bag, the container that holds your investments. Yeah, that's where the confusion often happens. Now, We're going to concentrate, as we said, on retirement accounts. And then retirement accounts break down into two major types: pre-tax, sometimes called before tax, and post-tax, sometimes called after tax. And here are some of the examples which we'll take a look at in more detail. You might have heard of the 401k, 403b. The traditional IRA is for everyone. SEP IRA, simple IRA, KEO. I love that. KEO. Reminds me of the Wizard of Oz. Yo-hee-yo, key. I know, it's kind of bizarre where my mind goes when I let it. You get a tax break now. Yippee! Tax deductible contributions. You get to deduct your contributions from the income tax, and the money grows tax deferred, and you pay taxes in retirement. Cool. So you defer your taxes. Very cool. But the newer version, started in what, 1998? Are the post-tax contributions, the after-tax contributions, the Roth IRA for almost everyone. Currently for everyone if you know how to do it, but maybe not. Starting in 2022, we'll see. Stay tuned. There's the Roth 401k, the Roth 403b, which we put in quotes because that's not what the IRS calls them, but more and more you see them without the quotes because people are just calling them that thing, calling them those things. The IRS just calls it a 401k with after-tax or post-tax contributions. And what you get with these is no tax break now. Oh, well, what good is that? You get a tax break later. In fact, you get tax-free in retirement. Very cool. So let's now slog through these pre-tax and post-tax contribution accounts. The most popular is the individual retirement arrangement. Is that the real name? Yeah, that's the real name. Nobody calls them that. Everybody calls them individual retirement accounts, but the real name, the legal name, is individual retirement arrangement. And they are now referred to as the traditional IRA to differentiate them from the Roth IRA. And anyone with earned income can contribute to a traditional IRA. There's some confusion about this. Some people think, oh no, I make too much money. No, it's not true. You can always contribute to a traditional IRA. Doesn't matter how much money you make. You make $1 million, boom, you can contribute to a Roth IRA. A traditional IRA, sorry, did I say Roth? Ooh. But here's where the confusion is. Normally, your contributions are tax deductible. They're pre-tax. Unless, here's the kicker, if you have a retirement plan at your place of employment, an employer-sponsored plan such as a 401k, 403b, and you make over a certain amount, you can still contribute, but you can't deduct the contributions on your taxes. It becomes a post-tax contribution. So you see where the confusion is? Yeah. Plus, we're going to see that the Roth IRA does have a contribution limit based on how much money you make. So it's our tax code. It's all 70,000 pages. The contribution limits are increasing with inflation, and your investment grows, as we said, tax deferred. Very cool. You pay taxes on the money as you withdraw it once you're retired. Typically, this is 59 and a half years old, although there are some ways to get the money out sooner, but just assume you're going to kiss this money and then send it on its way, come back to it when you're in your 60s, 70s, and afterwards. By the way, you have to start taking out what are called required minimum distributions. Currently, when you are 72, that's up from 70 and a half, and there's talk of even making it higher because why? People are living longer, they're working longer, they don't want to be having to take money out of retirement when they're still working. In fact, the Roth IRA, which we'll discuss later on, has no required minimum distribution. And why is that? Because William Roth, the senator for whom the Roth IRA was named for, was working in his 70s in the Senate. And he was having to take money out of his IRA. And he was saying, wait a minute, I'm still working. So he made sure that the IRA that bears his name had no required minimum distribution. Thank you, Senator Roth from the state of Delaware. And the IRA has many siblings and cousins and aunts and uncles. The 401k for corporations and other businesses. The 403B, 457, 401A, all these are employer-sponsored plans. And where'd they get the stupid names from? From the Internal Revenue Code. Yes, Section 401K of the Internal Revenue Code says if your company does this and you do that, Domini, Sanctus, Spiritus, the IRS blesses and kisses the plan and you don't have to pay taxes on your contributions and you get to defer all the taxes until you retire. And then there's the SEP IRA, the Simple IRA, the Solo 401K, sometimes called the Independent 401K, the SAR-SEP, which is no longer around, but if you had one before 1997, you get to keep it. And then there's the KEO, and they all work the same way, pretty much. Tax deferred growth, and then you pay taxes in retirement. Now, the Roth IRA, the Roth 401K, the Roth 403Bs work in reverse. They are post-tax, and we'll concentrate on them in just a few slides. So here's how it works. Let's say you have a 401k at work. You contribute via your paycheck $100. Now, much depends on your marginal tax rate, which we spend quite a bit of time in Business 121, Financial Planning and Money Management, and very few of the students actually understand it and remember it by the end of the semester, but that's okay. Let's say you're in the 25% tax bracket. The feds are going to give you 25 bucks. Woo-woo-woo. Well, not really. They're just going to take 25 fewer dollars out of your paycheck. Cool. The state of California, well, there's really no 8%. There's 4, 6, I forget exactly. But let's say there's 8%. It goes all the way up to about 10 or so. Let's say you're at 8% tax bracket for the state of California. That means the government is going to subsidize your $100 contribution to the tune of $33. So your take-home pay is only going to be reduced by $67. But the whole $100 goes into your account. And we are not even taking into account any match that the employer might give you. You put in 100, they put in 50. You put in 100, they put 100. Now, why would they do that? Well, because the nature of retirement plans are changing. What's going on? Companies used to put away money on their own for the benefit of their employees and offer a traditional pension plan, what the IRS calls a defined benefit plan. But they're not doing that anymore. It's all on you, which makes more sense. People don't work for a company for 30 years and then get a handshake and a golden watch or whatever. It doesn't work that way anymore. People bounce around, so it makes more sense for the retirement plan to follow you around. Now, there's a problem with that. The problem is that if you don't contribute, which some people don't, if you panic when the markets fall, you put all your money on red number 7, when the market's gone up 100%, then the market, is going to be bound for a rebound and you're already out. You wait for it to come back 100%, and then you put your money in only to see it fall another 30%. You see, if you don't invest prudently, wisely, consistently, yeah. However, the good news is you have the good news, and you know how to choose mutual funds that are long-term oriented, that have done well over decades in good times and bad times. You're going to consistently invest $50, $100 a month, more if you can afford it, as your salary goes up, as you get older and the debts go down. You're going to have a much better retirement plan than anything the companies are going to offer you. You see? So the opportunity is there, but so is the danger. So think about it. You put $100 in, you only see $67 come out of your paycheck, plus you might get an extra $50 or $100 in your account. What's the catch, right? There's got to be a catch, right? Well, yes and no. You pay income taxes on any amounts withdrawn in retirement, and people in retirement are usually in a lower tax bracket. If not, congratulations. If you're in retirement and now you're in a higher tax bracket because now you're pulling out tons of money out of your 401k or IRA, I certainly desire that all my students, all my clients, all people who read this have that terrible, terrible situation in their golden years. Yeah, too much champagne. What else? If you withdraw the funds before retirement, what are they going to do? They're going to smack your wrist. They're going to make you pay the income tax, and you have to pay a 10% penalty. The IRS doesn't call it a 10% penalty. They call it a 10% additional tax. Whoopee. There are exceptions for first-time home purchase, higher education expenses, medical disability, financial hardships. So there are ways for you to get to the money. But in general, again, give it a kiss, send it on its way. It's going to come back to you manyfold, assuming the world doesn't end and you invest prudently, wisely with an eye toward long-term growth of capital and income. You're going to do okay. I think so. Cool. Now, what happens if you decide, I'm going to go the Roth route? I'm going to open up a Roth IRA, or I'm going to choose the Roth 401k. Well, guess what? No tax break now. You put in $100. What does the feds give you? What does the state of California? So no government subsidy. Your disposable income is reduced by 100, and again, we're not taking into account any match you get from your employer if it's a Roth 401k or Roth 403b. So why contribute to a Roth IRA? In fact, you're probably going to get that question from people because now you're the investment guru. Why do you contribute to a Roth IRA? And you're going to say, because a Roth IRA is so cool. Well, that's what I say. Tax-free, the IRS wants us to say tax-exempt, in retirement is a golden opportunity. No other investment account option comes close. Now, there are some scenarios if you bent yourself into a pretzel where it might make sense for you to... No. The Roth is awesome. I think they're going to get rid of them. There's already talk in Congress, as of late 2021, of paring them back because there are some very celebrated cases where multimillionaires have been able to put certain securities into their Roth IRA that they were allowed to get, and they turned into billions of dollars, and now it's all tax-free. So obviously, this is not what the Roth IRA was meant for. It was meant for grunts like you and I. So we'll see what happens with that. But another cool thing of the Roth IRA that people don't often think about is that you can withdraw the contributions at any time without penalty. Well, that makes sense. You've already paid the taxes on the contributions. So that makes the Roth IRA an excellent intermediate term investment account for the purchase of a house or for college expenses. People say, should I start an educational savings account? And I say, well, if they're in the middle class or somewhere in there, I say, have you maxed out your Roth IRA yet? And they say, no. I said, do that first, because there's some nasty things that the educational savings accounts do. They're great for people who have a lot of disposable income, but for the vast majority of us working grunts, it's better to go with the Roth IRA. Plus, when you go fill out that FAFSA form, some people call it the FAFSA form, but it's a FAFSA form. They don't ask you how much is in your Roth IRA. Now, some of the private universities do. Before they'll give you financial aid, they'll ask if you have a Roth IRA because they consider the Roth IRA liquid because you can take out the contributions. But still, for the vast majority of us working grunts, I'm a big fan of the Roth IRA. Slide 17. But the Roth IRA is not for everyone. Well, yes, it is. We're not supposed to say this, but it is. You just have to learn how to navigate the paperwork. There are limitations on the Roth IRA contributions. In 2021, only single taxpayers with an adjusted gross income of $125,000 or less, and married couples with an adjusted gross income of $198,000 or less can fully contribute to a Roth IRA. And again, if you don't qualify, congratulations. However, you can still contribute to the Roth IRA anyway. Well, think about it. A lot of people don't even know how much money they're going to make, especially if their income is dependent on commissions or business or whatever. So if you find that you've made over the limit, or you knew you were going to go over the limit, you can recharacterize the contributions into a traditional IRA, which does not have the same limitations, before you file your taxes. You see this? It's called recharacterization. You say, oops, I made too much money, or I knew I was going to make too much money. So I'm going to move my Roth IRA contributions into a traditional IRA. Now, on the same day, you fill out the paperwork, you turn in the money in, you turn in the paperwork on the same day. You move the money back into the Roth. You convert the traditional IRA contributions back into the Roth IRA. Who voted for these bozos? Oh yeah, yeah, we did. Everyone can agree that the tax code is broken. We can't agree on how to fix it. Now, again, late 2021, there's talk about getting rid of the Roth IRA backdoor. So we'll see if it makes it through Congress. But this is called the Roth IRA backdoor. And it's so ridiculous. Why don't they just let people... They're going to... I think what's going to happen, I'm pretty sure it's going to happen because it's bipartisan, meaning both the Republicans and the Democrats are agreeing to it. They're going to put limitations on how much money you have in these things, and after you have that much money, no more contributions, and then you have to start taking money out immediately. You can't just let it grow, and then eventually have billions of dollars in there. These high net worth individuals. But the backdoor, we'll see. I just wish they could get rid of it, so that everybody can contribute, except for the very high net worth people who it wasn't meant for them anyway. They don't need a Roth IRA. It's the working grunts who need this. Okay. Whew. Now, the contribution limits, as we said, are indexed to, did we say that? They're indexed to inflation. So they go up over time as inflation goes up. In 2021, 2022, the Roth IRA contribution limits are $6,000 for people under 50 years of age, and the traditional IRA, the same. And if you're 50 or over, you get to add an extra $1,000. Now, this doesn't mean you can open up 10 Roth IRAs and put $6,000 each. No, it doesn't work that way. The $6,000 is the total of all your accounts, whether they're traditional IRA or Roth IRA. So you can't open up 10. Oh, I'm going to open up 10. No, it doesn't work that way. And the contributions are limited to the lesser of your gross salary or your maximum yearly contributions. So if you make at least $6,000, you can put $6,000 into your Roth IRA or traditional IRA. And you don't have to wait. You don't have to do it by December 31st. You have until April 15th of 2022 to put the maximum into an IRA or a Roth IRA for 2021. So you get until tax time to get the money in there. And if your spouse is not working, but you are, you can contribute on their behalf if he or she does not work. And as we said, the contribution limits rise with inflation. Now, we don't see it here because inflation didn't go up enough for the next tick. They go up in $500 increments. But we're going to see it on the next slide because these are the contribution limits for the employer-sponsored plans, 401ks, 403bs, 457s, and these are much more generous. Woo-hoo-hoo-hoo. 2021, $19,500 if you're 50 or under. If you're 50 or over, you can add an extra, $6,500? And it's going up to $20,500 next year, 2022. Yes. So if you make that much money, you can put the entire amount into a 401k or a Roth 401k. And so what I tell younger folks, I say, look, you're both working? Great. One of you put the maximum into your 401k, 403b, whatever. The other one, you live off of their income. If you're in your later 20s, early 30s, you do that for 5 years. Just do it for 5 years. Now, of course, hopefully you'll keep putting more money away as you go along. But you do that for 5 years, you'll never have to put another dime away for retirement. And people didn't believe me. I said, well, come to my office, we'll do some illustrations. And their jaws dropped, this one couple. And they looked at each other, oh, I think this is a great idea. Because they were both making a decent salary. They weren't super rich or anything, but now they saw, hey, if we do this just for a few years, woo, woo, woo. And if you're in the public sector, now I didn't believe this when I first heard it. This was way back in 2002. They said, oh, you can put the max into a 403B and a 457. So I spent a lot of time getting to somebody at the IRS and asking, is this true? Can we really do this? And finally I got the answer from the IRS agent saying, yeah, we've ruled, yes, it's okay. So now if you're at Southwestern Community College and you teach at Southwestern or you work at Southwestern, you can put the maximum into a 403B and the max into a 457. Pretty amazing. Now, the Roth 401k, the Roth 403b, that's not what the IRS calls them. They just call them 401k with after-tax contributions, but that's what everyone else calls them. If your employer offers the option, they don't have to, but if they do, you are able to place after-tax dollars into your Roth 401k, your Roth 403b, which is, again, great for people who are not making a whole lot of money. They're in a lower tax bracket. They don't need the tax break now. However, the employer matches will continue to be pre-tax. So you've got this situation where some of it's pre-tax, some of it's post-tax, and you got to keep track of that, right? And obviously with modern technology, they're going to keep your statements forever, but you should download that last statement of the year, the December 31st statement, and stuff it away somewhere in your electronic life so that you'll never lose it, because you don't want to come back 30 years from now and have the IRS say, oh, it's all taxable. No, I put in after-tax money. You don't want to pay taxes twice. By the way, it's not as flexible as the Roth IRA. Contributions are not able to be withdrawn without penalty or taxes until retirement. So that provision is not there. Although some of these programs allow you to borrow from them, but that's a bit of a problematic situation because you have to pay it back within a certain amount of time, or the IRS says, oops, you withdrew it. So I'm a big fan of the Roth IRA, preferably unless your employer offers matching contributions. Then again, that's free money. The Roth 401k, Roth 403b is a better option. So, but they're both great options. And sometimes people say, well, should I put money in my Roth IRA or my 401k? And I say yes. And they say, wait a minute, that's not what I asked you. I say, yes, do both. That's what I did for many years. I put money into our Roth, my wife and I, and money in our 403b, and you got the best of both worlds. You got a tax break now, and you get a tax break later. Very cool. So, slide 21. Another very cool thing about retirement accounts is that you may be eligible for tax credits. Now, what's a tax credit? A dollar for dollar reduction of your income taxes. So depending on your situation, every situation is different. Say you put $50 a month away into a Roth IRA. That's $600 a year. They might give you a tax break of $300. Pretty darn cool. So if you do your own taxes, don't forget this. Now, it's supposed to be for low-income earners, but I don't know about you, but $66,000 a year for a married filing jointly, that's not too shabby in my humble opinion. $68,000 in 2022, going up for inflation. So make sure that if you have somebody do your taxes, make sure you tell them, I put money away in a Roth, or I put money away in a 401k, or if you do your own taxes with TurboTax or TaxSlayer or whatever tax act, make sure you put it in there because the software will quickly say, oh, you're getting a tax credit. Very cool. Okay, so that much for retirement accounts, tax qualified accounts. As we said, educational savings accounts, health savings accounts, medical savings accounts. They're similar, same provisions and the like, but they're designated for other tasks. So if you're in that situation, you might want to educate yourself about those. But we're not going to discuss those, but they're there. But now it's time to talk about annuities. Yeah. Annuities are life insurance products. They are designed to provide a guaranteed income. Oh, doesn't that sound wonderful? A guaranteed income for a certain amount of time, or the most popular being the life income option, or just the life option. For as long as you live, there's no way you can outlive this money. That, for many people, is incredibly tempting. Is there a catch? Oh, there's more than one. The amount you get is based on your age, which of the above options you choose, how much you've contributed, how well your annuities investments, if any, have performed over time. Because there's two different types of annuities. Well, there's actually many, but two major. The fixed annuity, where you know how much money you're going to get. They invest basically in bonds, right? You don't. The insurance company does. And then there are variable annuities where you get to choose your investments, and they're typically mutual funds. And when this happened, the Securities and Exchange Commission jumped up and down and said, wait a minute, because the insurance companies are regulated by the states, not the feds. And when they did this, the Fed said, oh, this is our jurisdiction. So now, if you're an insurance agent and you want to sell annuities, you've got to get the Series 6 at the very least, and you can get the Series 7. The Series 6 is just a watered-down version of the Series 7, typically meant for insurance agents who are going to sell these variable annuities. And you say, well, what's wrong with this, huh? It sounds pretty good, right? I mean, they're going to allow me to invest if I want to with a variable annuity, or tell me exactly how much I'm going to make and give me an income for life. I mean, what's wrong with that? Slide 23. There are advantages. Well, annuities are very flexible. They can be funded with retirement account dollars or after-tax dollars. Remember we said that most tax-qualified accounts, there are contribution limits? Well, not with a tax-deferred annuity. Yeah, that's one advantage. The life insurance companies are very powerful. The interest is earned and is tax-deferred, and you pay taxes on any pre-tax annuity contributions and all tax-deferred earnings as you withdraw them in retirement. And again, as with other retirement plans, when you retire, you will likely be in lower income tax bracket. So what's the problem, Piana? Why you got this axe to grind? Look, folks, these things are outrageously expensive. The annuity company usually takes between 1.5%, 2%, 3%, upwards of 4% every year. And if it's in a variable annuity, that's on top of what the mutual fund company is charging. Outrageous. But if you're an insurance agent, would you love to sell these things? The commissions are fabulous. They'll even send you on an all-expense paid Caribbean cruise. Not the clients, not the annuitants, as they're called, the annuitant, the person who owns the annuity, who's the beneficiary of the annuity. No, the insurance agents. And as I've told you, I'm an insurance agent, so I can tell you the true things about stockbrokers and insurance agents. And because they're so icky, they usually come with very restrictive provisions. Do you remember the contingent deferred sales charges from mutual funds? Started at 5%, 4, 3, 2, 1, and disappeared after 5 years? Tax-deferred annuities usually have what they call surrender schedule or surrender fee, and they start at 20 or 25%, and it takes 20 years, or sometimes 10 years, it's not called the contingent deferred sales charge, it's called the surrender charge. It takes that long for the thing to disappear. So there are huge penalties if you decide or find out that you've been screwed. I mean, you bought something that wasn't necessarily in your best interests, but your insurance agent got an all-expense paid cruise to the Caribbean, and so it made it all worthwhile. Yeah, I know. Hey, in fact, one guy almost cleaned my clock. He was about ready to hit me. This was at a seminar with a bunch of brokers and all professionals, and his buddies grabbed him and pulled him away, and he came back and apologized. Because I on several occasions, I said, look, I don't think these things are in the best interest of our clients. And when people get angry at me, I say, look, I'll make you a deal. You show me your best tax-deferred annuity, and I'll show you my best, investment plan, which mutual funds. And if yours is better than mine after 20 years or 25 years, I'll buy yours. I'll buy your product. If mine's better than yours, you buy mine. And no one's ever taken up on that offer because they're not stupid, right? One guy says, well, you're not comparing apples to apples. You're not. It's not a fair comparison. I said, you're absolutely right. Yeah, how can I say? But I'm a lucky guy, right? I lived off my salary at Southwestern. Thank you very much, Southwestern College, and whatever I made as a broker, it's all gravy. So thank you very much. So that's our thwacking of annuities. And by the way, Mr. Ken Fisher, if you look at Fisher Investments, in his gravelly voice was, I hate annuities, and you should too. So in that respect, we are in agreement. So to review our choices, there are the regular accounts, which you can open up any investment type, any contribution amount, pay taxes every year. And then there are the pre-tax contribution retirement accounts, post-tax contribution, the Roth IRA being the jewel of the crown here, and then the annuities with their high fees and their tax-deferred earnings. And that, dear students, is our discussion of brokerage firms, account types, and annuities. And if you still have any questions, especially because I know it's a little tricky, the difference between a Roth IRA and the traditional IRAs, and the difference between the investment that's inside the Roth or the 401k or whatever, you know who to contact. Because we are ready now to finish our journey with our last chapter, starting a business. The ultimate investment. Hey, it's not for everyone.